Well, your resume is impressive, but what would you say is your greatest weakness?
I daydream constantly about living by the water, the warm sun, in a dynamic city with amazing food and craft breweries, weekend events.
Okay.
With tons of jobs, less stress, awesomely affordable neighborhoods.
It sounds glorious.
Stop daydreaming and get to Tampa Bay for high-wage jobs in finance, tech, and more, all under the warm Florida sun. Find Florida's most bright opportunities at makeitTampaBay.com.
Say goodbye to your credit card rewards. Greedy corporate mega stores, led by Walmart and Target, are pushing for a law in Congress to take away your hard-earned cash back and travel points to line their pockets. The Durbin-Marshall credit card bill would enact harmful credit card routing mandates that would end credit card rewards as we know it. If you love your credit card rewards, tell your lawmakers, hands off my rewards. Tell them to oppose the Durbin-Marshall credit card bill.
Hey, welcome back to Everyday Economics. The podcast helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can check out all of our podcasts at americastalking.com. To support podcasts such as this one, please make a tax-deductible charitable contribution by clicking the link in the show description. We are recording this episode on Friday, June 14th. And joining me, as always, my friend and colleague, Dr. Orphe Divounguy, PhD economist. Dr. O, real life, every once in a while, sort of comes to the fore, even on podcasts and on the internet as a whole. Taking a look at the realities of household debt and credit, that report just came out from the Fed. We've been talking about, on the show this week, we've been talking about, the buyer's opportunity and the reality of sellers in the home market. We've talked about, this easing of inflation. And those are, I think, sort of interesting turns. I mean, if you follow the economy, and I don't know who follows the economy more closely than you do, but I think the average person who follows the economy is looking at this in any number of ways. They don't have as many dollars to spend. And their dollar might be going a little bit further at this point, but they're sort of running out of cash. The household debt and credit report from the New York Fed came out this week. This is again the measurement at the end of Q1 2024, and household debt has climbed to $17.7 trillion, and the delinquency rates they're on the move up. I mean, for people who, follow the used car market, started to see that prices are coming down, which is a nice change, in particular for used cars, which have been kind of hanging up there. Of course, the production 2020 and 2021 model years, there weren't nearly as many cars built worldwide. Let's make sense of this data. What does this mean? I mean, total household debt rose by $184 billion in the first quarter. Is it just as simple as people have less money and they owe more?
Well, so first of all, let's just make sure we address the doom and gloom first. Delinquency rates overall, aggregate delinquency rates are still 1.5 percentage points below where they were in 2019 before the pandemic. So ultimately, even though the consumer is slowing down, even though, the economy is slowing down, and the consumer's been faced with higher inflation and higher interest rates, and the consumer's excess savings have dwindled, essentially, I think the consumer's still in a good place. Now, where's the uptick coming from? The uptick is coming from auto loans delinquency, right? And it's very much concentrated in kind of the younger segment, 18 to 39. The 18 to 39-year-old population, are starting to see, that it's not always a good idea to try to keep up with the Joneses. And they're facing higher delinquency rates. They're struggling to keep up with the expensive car payments. And that's where signs of weakness are and signs of trouble are showing up. But for the rest, the balance sheet is still pretty healthy for the rest of Americans. By the way, those people that are taking out new credit today are some of the highest credit scores, and they're getting bigger and bigger credit card limits as a result. They're wealthier. Remember, most Americans are sitting on record home equity. They have a ton of housing wealth. The stock market has reached new highs. And so they also have a ton of financial wealth. And so they can afford to take out more debt. If you look at debt servicing cost as a share of income, we don't have the number for Q1 yet, but as of Q3, it was still below pre-pandemic levels, below 2019 levels. And so what that tells me is, yes, there are signs that, people are getting squeezed with higher interest rates, but that's concentrated among kind of younger people, perhaps people who don't own a home yet, perhaps, folks who are not in jobs, right? They're not, earning as much as they will be soon because they're younger. They haven't gotten to that peak earnings yet, peak lifetime earnings yet. And so that's where the signs of trouble lay, right? So the credit cards and auto loan balances of younger folks, ages 18 to 39, according to the New York Fed Consumer Credit Panel. It's a New York Fed and Equifax data. This report produced by the New York Fed, which, by the way, I love this report. It tells you so much about the state of the consumer's balance sheet.
Well, let me throw a couple stats at you. I was taking a look at bank rates, aggregates, and they're pulling in numbers from Experian. As of, I believe that this was, calculated at the end of May. Right now, the average monthly car payment for new cars is $735 a month. And then the average cost of car insurance right now on a monthly basis is $192 a month. So, you're somewhere between, $900 and $1,000 in obligation on a new car payment and the insurance for it. And even like the average monthly car payment for a used car is $523 a month. So, that's a sizable chunk of frankly, most Americans' monthly budget. It's pushing into,
it's a small rent.
Some markets, it closely resembles rent. And while you need a place to live, and obviously the basic needs, place to live is a basic need. In America, the reality is, in most places you need an automobile that allows you to go to and from your workplace or just simply to go to the grocery store. That's a significant amount of money. And how much is that contributing, frankly, to the at-home realities of Americans today?
They're feeling it, right? We had a report, Zillow had an interesting report showing the income needed to comfortably afford a house payment today is about $106,500, right? So you add all these things up, man, with higher interest rates and inflation still where it's at, and it's going to make a dent on the budgets of people whose wages haven't been able to keep up or who are not invested in the stock market and haven't been able to see their financial wealth increase or who are not homeowners yet, right? Look, rents increased so fast during the pandemic. Rents increased so much faster than wages during the pandemic. And so, if you're a renter, you definitely felt the squeeze. Now in the past year, it's good. The good news is wages are now increasing faster than rents, but there's a lot of catch up to do, right? And so I think people, especially younger folks or renters, right, who don't own their home, are definitely feeling the pinch, and that's kind of the unfortunate circumstance, right? We keep hearing about the vibe recession or whatever I see out there, and people complaining and being, consumer sentiment. How about this? Data on consumer sentiment just came out, right? And consumer sentiment is, I think, reached a 7-year low, right? This is why, right? This is why I think people are feeling inflation fatigue, and, I saw their excess savings dwindle to nothing, and have accumulated a ton of credit card debt and are starting to wonder, okay, well, I need to keep my job now. By the way, you're seeing it. Quits are way low. People are not quitting their jobs anymore. They're staying put, right? And it's like, hey, I need to keep my job just to keep making those payments every month. I think that's probably what's happening, but it's happening more. It's more concentrated towards the younger folks, right? Gen Z, younger millennials are the ones really feeling the pinch.
Well, I appreciate your thoughts as always, Dr. O. For Orphe Divounguy, this has been Chris Krug. Make sure you check out Dr. Orphe Divoungui's column each Monday at centersquare.com. And please remember to subscribe to Everyday Economics at americastalking.com.
Well, your resume is impressive, but what would you say is your greatest weakness?
I daydream constantly about living by the water, the warm sun, in a dynamic city with amazing food and craft breweries, weekend events.
Okay.
With tons of jobs, less stress, awesomely affordable neighborhoods.
It sounds glorious.
Stop daydreaming and get to Tampa Bay for high-wage jobs in finance, tech, and more, all under the warm Florida sun. Find Florida's most bright opportunities at makeitTampaBay.com.
Say goodbye to your credit card rewards. Greedy corporate mega stores, led by Walmart and Target, are pushing for a law in Congress to take away your hard-earned cash back and travel points to line their pockets. The Durbin-Marshall credit card bill would enact harmful credit card routing mandates that would end credit card rewards as we know it. If you love your credit card rewards, tell your lawmakers, hands off my rewards. Tell them to oppose the Durbin-Marshall credit card bill.